Okay, global minimum tax deal. Now this is a very revolutionary thing, and I have made at least 2-3 lectures on base erosion, profit shifting, how companies are not complying with the tax norms. In one of my lectures dealing with the Vodafone tax case, and one of the lectures dealing with equalization levy. I have made all these lectures and you must go through them. Okay. Now let's see what is global minimum tax deal. Now G20 must ensure, the news is, see again we have two news, one from the past and one from the present. The first is, this news was taken from July 14, 2022, this month itself. This is from October 31, 2021. The minimum corporate tax deal to roll out globally from 2023. This was the news in October 13, 2021, when at this conference around 130 countries agreed with going forward with the global minimum tax. What they agreed with? Going forward with global minimum tax. Okay. Now the news is, Nirmala Sitharaman, Honorable Finance Minister of India, she has recently in a G20 conference of finance ministers said that G20 must ensure developing nations earn meaningful revenues. Okay, meaningful revenues. Why she has said? Like when WTO was negotiated, World Trade Organization was negotiated, or GATT was negotiated. Okay? So we have seen in our previous lectures how developing countries like India and China are at disadvantage because of the Amber Clause, the Amber Box Subsidy Clause that has been included into the Agreement on Agriculture. Okay? The Agreement on Agriculture talks about 3 kinds of subsidies. The first one is Green Box, the second one is Blue Box, and the third one is Amber Box. So Green Box and Blue Box subsidies are not limited. Okay, they can be provided by any amount by the government. But the third subsidy that we talk about is Amber Box subsidies. These subsidies are limited to 10% for developing countries and 5% for developed countries. Okay. It sounds very fair that developed countries should be providing lesser number of subsidies, 5%. And developing countries, because they are developing in nature, their demands and needs are very high. Okay, so that is why they should be able to provide more than the developed countries. That is around 10%, at least double, right? But this is not very fair, because now Amber Box subsidy talks about 5% of the 1988 production value and 10% of the 1988 production value of the developing countries, and of course similarly developed countries. The problem here is that 5% of the production value of developed countries was way greater than the 10% of production value of developing countries in 1988. That means, although in absolute numbers it sounds fair that the developed countries should have a lower quota, right? But when we get into the details of it, the devil lies in the detail. When we get into the details of it, we will find out that the 10% of developing countries is lesser than 5% of developed countries. Due to such negotiations, what has happened, that developing countries are at disadvantage vis-a-vis developed countries in terms of offering subsidies to their farmers. Now such concerns have again come out, although India has agreed to it. The G20 conference last year, India along with 136 other countries, okay, other countries have agreed to this deal, but it is also saying that meaningful revenue should be, the deal should be such that meaningful revenues for developing countries should accrue to, This global minimum tax deal should lead to formation of or accruing of meaningful revenues for developing countries as well. Let's talk about it in more detail. Now, what is global minimum tax? It is an international corporate tax. Okay? It is a corporate tax. Now, if someone asks you what is corporate tax, direct tax or indirect tax, it is a direct tax. Okay. It is why? Because it is levied on the income of the corporate. Okay. It is levied on the income of the corporate. It is an international corporate tax deal which was agreed to by around 136 countries in October 2021. The aim of this tax is to prevent the base erosion and profit shifting. What is the aim? Base erosion and profit shifting. Okay? It seeks to tax the multinational companies. Okay? What it does, it seeks to tax the multinational enterprises which are operating digitally transboundary and non-digitally also across the boundaries. Okay, which have $868 million in sales annually. If some multinational is having more than this, they will be considered for GMT. Okay, this would help countries tax the companies which shift their profits, which shift their operations to tax havens, which shift their profits to tax havens. Tax havens means those countries which have very low taxation rate. Okay, and since they shift most of their profit to tax havens, the country they are actually operating in, they are left with no taxable income at all. Okay, so they avoid paying taxes in countries like India, and instead they pay taxes in the very low tax jurisdiction like Panama or UK. Understood? So this is how to counter this base erosion and profit shifting. Base erosion means erosion of tax base, profit shifting means shifting of profit to a lower tax country. Okay. Now what is base erosion and profit shifting? Now what is a base erosion and profit shifting? First of all, look at this slide. There are 140 countries in the framework of BEPS. There are 140 countries in the framework of BEPS, base erosion and profit shifting. Now, very important point is base erosion and profit shifting is a framework of OECD, Organization of Economic Cooperation and Development. One point that we have got. Okay. Now, if we look at this, 136 countries have agreed. India is one of them. 4 countries have not agreed or not joined are Kenya, Nigeria, Pakistan and Sri Lanka. 4 countries which have not joined. Sri Lanka and Pakistan, we are already seeing they are facing a very strong economic crisis right now. Kenya and Nigeria are also not very economically not very stable countries. Okay. Now, why these countries have not joined? Because they seek to, might be they are seeking to create tax havens for themselves. Okay, let's see. The biggest contributors to tax losses, that means those countries which are tax havens, which are siphoning off the most of the profit. Okay. The Netherlands 26.6% billion dollars, Cayman Islands $22.8 billion, China $20 billion, Hong Kong $16.3 billion and UK $13.7 billion. As you can see, why all these tax evading people go to UK, England. Okay. Now let's look at the countries that are losing big time. US more than $49.24 billion. Okay. Germany, India is also losing a great deal of money in this base erosion and profit shifting. Okay. Base erosion and profit shifting. Let's try to understand in a very small brief explanation as to what base erosion and profit shifting actually is. The base erosion and profit shifting consists of 2 terms. The first one is base erosion. Okay? The first one is base erosion and the second one is profit shifting. ठीक है. Now let's consider an example for this. For example, this is India. ठीक है. And tax rate in India is 26%, corporate tax, right? This is USA. Okay. The corporate tax rate is 30%. These two countries are normal countries with higher corporate tax rates. Now comes into the picture Cayman Islands. ठीक है. Cayman Islands. See, there is not only one method for BEPS. There are multiple methods. I am talking about one of them. Okay. Understood? Now how? There is a company called Google. ठीक है. Or let's remove this name. Let's do not create any kind of controversy here. There is a company called XYZ Corporation in USA. ठीक है. It operates digitally. It is headquartered in USA. Okay. That means the company is located in California, somewhere in California. But since internet is accessible by everyone, ठीक है, so anything that this company builds, for example a search engine, can be used in India as well. ठीक है, can be used in India, right? For example, this company built a search engine and it promotes, for example, a video streaming channel they have started. ठीक है, and some user in India, ठीक है, user in India put an ad, ठीक है, put an ad on that streaming website. Okay. So what will happen? They will be paying money not to Google India but to Google USA. They will be paying money not to Google India but to Google USA. ठीक है? Understood? Simple. Now the government of India sees that this company is making money in India. This company is making money in India. They are taking away Indian investment, and government is not able to tax them. Government is not able to tax them because they are not located in India first, right? Now this leads to loss for government of India. Okay, understood? For that, government brought equalization levy. Equalization levy. Okay, to counter this, because XYZ is not located in India, but it is still making money out of India, right? For that, government said that no, this is loss of tax revenue for us. We will have to get some method to pay them, make them pay in India. What they did was, they said, okay, you are not located in India, does not matter. If you are making money from India, you will have to pay 6% of the money you made if the ad revenue for you was greater than 1 lakh rupees. If the ad revenue for you was greater than 1 lakh rupees. Understood? Okay, simple. They brought this equalization levy. Fine. Now I hope you understood up till now. Right? Now this part can be removed. This part can be removed. Okay, let's not remove this. Instead, okay, fine. So what happened is, XYZ Corporation is not located in India, but its services are being used by Indians and they are making a payment to that. अभी तक तो ये समझ में आ गया. Now India को remove कर दो. ठीक है? तो I hope you understood up till now. Now what happens is, they are located in USA, where the tax rate is 30%. ठीक है? What this company does is, they open an office in Cayman Islands. They open an office in Cayman Islands where tax rate is 1%. Okay. Then they open an office in XYZ Corporation Holdings. Okay, holdings. Now what is holding? Holding is not a real company. Okay. It is a company which holds shares of other company. Shares of other company. That means although XYZ is headquartered in USA, for example, 80% of shares, okay, shares are held by XYZ holding in Cayman Islands. 80% of share means 80% of the ownership of the company, right? Understood? Plus all the IP, intellectual property rights also, plus licenses. Okay? That means if this company makes a revenue of 1000 rupees per year, for example 10,000 rupees per year, right? First of all, 80% of shareholding, that means 80% or 8,000 of these rupees will be flowing back to Cayman Islands, right? They are now left with 2,000 rupees. Then they will have to again pay to XYZ Corporation for their IP rights, for using their IP rights and licenses. See what the company is doing. The company is transacting between itself. That holding is a subsidiary company of XYZ Corporation. But this corporation says that since that company is holding all the IP rights and licenses, I will have to pay them to use that, right? And these licenses, now they are, for example, making a payment of 1500 rupees for using these licenses and IP rights. Understood? So what they do, they are now left with 500 rupees. Then they say कि we have operating cost of 250 rupees here in USA. They have operating cost of 250 rupees in USA. Now they are left with only 250 rupees. Okay? That is their net profit. They will be paying 30% of 250 rupees to US government instead of 30% of 10,000 rupees, that is 3,000 rupees. Understood? This is how they are not paying tax in India. They are not paying tax in USA. They are paying 1% tax of 10,000 rupees to Cayman Islands. Understood? That is how they are shifting their profits to Cayman Islands and eroding the tax base in USA and India. Right? They are shifting their profits to Cayman Islands, and they are also eroding the tax base in USA and India. So this is called tax erosion or tax base erosion and profit shifting. Okay. Now to counter this, a lot of provisions have been brought in by OECD. OECD means Organization of Economic Cooperation and Development. In 2015 itself, OECD released a 14-point action plan, and India in 2016, after the release of this 14-point action plan, in 2016 itself brought this equalization levy. Equalization levy means a tax charged on multinational corporations which are not operating in India but still taking revenue from India. That will be 6% of their net revenue if the revenue is more than 1 lakh rupees. Okay. So there are 14 points. I have brought here the most important of the points. The first one is address the tax challenge of digital economy. Digital economy means since the brick and mortar business is no longer existing, the one company can be located in some place and it can operate globally, right? So how should the countries devise their tax norms so that they can be able to tax these companies for the operation in their own country? Okay. Address the hybrid mismatch agreements. Hybrid mismatch agreement means, for example, there are two countries, India and USA. So there are the domestic tax laws of India, domestic tax laws of USA. If there is a lot of difference, the companies can exploit this difference and avoid paying taxes. To address that, the company should harmonize their taxation laws. That is what hybrid mismatch agreement. Prevent treaty abuse. For example, there is a double taxation avoidance treaty between India and Mauritius that can be used by some countries where they can be bringing money through that route, Mauritius route, and they will be avoiding paying taxes in Mauritius and India as well. Okay. To avoid treaty abuse, data sharing amongst the countries to look for which companies are avoiding these taxes, so they can be prosecuted. Assure that transfer pricing outcomes are in line with the value creation. Now, what is transfer pricing? Okay. This is also an important term that I would like to explain in a bit. What is transfer pricing? Okay. Transfer pricing and arm's length principle. Okay. See, I said that XYZ Corporation, okay, it is located in USA, and XYZ Holdings, okay, XYZ Holdings is located in Cayman Islands. Okay. See, both of them are same companies. Okay. Both of them are same companies. Lekin they say that XYZ Corporation says that since XYZ Holding has all the licenses and IP rights, I will have to pay it 8,000 rupees out of my 10,000 revenue. So what is the basis of this transaction? What is the basis of this transaction? They are transacting amongst themselves. Are they transacting in the similar way, in the way that XYZ Corporation will be transacting with some other corporation ABC? See, XYZ Corporation and XYZ Holding are same companies, but XYZ and ABC are different companies. ठीक है. अब XYZ Corporation का main aim क्या होगा? To minimize its tax. For that, they will try to siphon off most of the money to this company. ठीक है. But if there is an agreement between this company and this company on purchase of something, so XYZ will try to minimize this cost, right? Minimize this cost, and in this case they will try to maximize the cost so that most of the money could be transferred out. That means transfer pricing is that pricing which takes place, the cost of the transaction that takes place between the subsidiaries of the same company. That is called transfer pricing. Now, arm's length principle states that a company should transact with its subsidiary in the similar manner as it would transact with the outside company. That means XYZ Corporation should treat XYZ Holding in the same way as it would treat ABC Corporation. Understood? This is called arm's length principle. Okay. Now, what are these features of GMT? Okay. There is a two pillar principle for implementation of GMT, global minimum tax. Pillar 1 says that reallocation of taxation rights to market jurisdiction based on establishment of a nexus. Okay. All multinational enterprise groups with gross revenue exceeding 20 billion euros and profitability above 10%. That means if a company is earning 30% profit, है ना, तो जो 10% के above वाला profit है 20 to 30%, okay, 10% के above जो 20% होगा, from 10% to 30%, that will be what? That will be taxable. Now let's look at pillar 1. ठीक है, let's look at pillar 1 in a brief. Okay. Reallocation of taxation rights to market jurisdictions. Market jurisdiction means, for example, Google is a US based company. Google की market कौन सी है? India, Pakistan, all these countries. ठीक है. So there will be a law that will be brought in, basically global taxation law that will be brought in to reallocate the rights of taxation based on the nexus. Nexus means that it is simple. That means Pakistan, India, Sri Lanka, and all these markets, the right to tax Google will be decided upon the proportion of revenue that company is making from a specific country. It is as simple as that. Given that the company that we are talking about has a revenue exceeding $20 billion annually. Okay, revenue $20 billion का हो और profit margin greater than 10% will be taxable by all these markets depending upon the nexus. Nexus means how much revenue that company is making from a particular country. Now, if you look at the nexus, the revenue earned by a multinational enterprise in a tax jurisdiction should be at least 1 million euros. Now, there are many markets. Market means tax jurisdictions, like India, Pakistan, Sri Lanka. All these countries are tax jurisdictions for US, Google, for example. So, how much taxation will India impose? How much taxation? See, the taxation amount will be, the amount that can be taxed will be greater than 10%. Okay, greater than 10% of the profit. Okay, greater than the 10% of the profit. Any amount greater than 10% of the profit will be taxed. Okay, now how much tax will be imposed? That will depend upon this pillar 1. Pillar 1 talks about the redistribution of taxation rights will take place based upon the nexus, establishment of a nexus. Now, what a nexus is? Nexus means a country can impose a tax on a specific entity, multinational entity, only if that company, that multinational entity is making at least 1 million euros from that country in revenue. For example, if Google is operating in Pakistan and Google is not able to make more than 1 million revenues from Pakistan, so Pakistan will not be a market which will impose tax on Google. Understood? That is the point. For countries with smaller GDP, if the country has smaller GDP, less than $40 billion, this threshold has been set up at 250,000 euros instead of 1 million euros. That is pillar 1. I hope you understood this. If any questions, you can ask me directly. Okay. Now, pillar 2. Pillar 2 is nothing. It says that globe norms will be brought in. Globe norms means global anti-erosion rules. Global anti-erosion rules will be brought in. Okay, that means if a corporation, for example, Google, okay, Google is being taxed 5% in India. Effective taxation of Google is, for example, 5% in India. So India can add 10% tax on this Google to raise it to 15%. This 15% taxation rate is GMT, Global Minimum Tax. Every country has the right to impose a minimum 15% tax on any country that is qualifying this criteria. With a gross revenue of 750 million euros, any company which is having a gross revenue of 750 million euros. Gross revenue is different from net revenue. Gross revenue means the revenue before taxation. Okay, if the company is making more than 750 million euros, then any country can impose a minimum rate of 15% tax on the country. That is called top-up tax. Top-up tax. Tax on the top-up of the imposed existing tax. For example, 5% tax agar exist karta hai, to bring it to minimum tax rate of 15%, the country can further add 10% taxation to that company. Okay, that is pillar 2. I hope you understood this. This was important, and it was important and interesting as well. So if you have any questions regarding GMT, kindly ask me in the comment section. I'll be more than happy to take them. Okay.